If you're holding XRP right now, you need to hear this clearly and without emotion clouding your judgment. Welcome back, because what's forming around XRP at this exact moment is not normal market behavior, and it's not something you can afford to misunderstand. This is not about short-term price noise. This is about a structural shift that only becomes obvious after it's already locked in. And right now, most people are positioned the wrong way for what's coming next. Here's the uncomfortable truth most investors don't want to face. Markets don't move when the crowd feels confident. They move when confidence is lowest and information is most misunderstood. That's exactly where XRP sits right now. The price has been chopping between roughly $2 and $3 for months. And that sideways movement has drained patience out of even long-term holders. Fatigue is everywhere. People feel like all the good news has already been priced in. And that's precisely why this phase is dangerous for the unprepared, because exhaustion is the emotional state that precedes both capitulation and violent reversals. Let's rewind for a moment. Not that long ago, XRP was sitting below 50 cents. At that time, the narrative was identical to what you're hearing today. Dead project, underperformer, regulatory risk, no momentum. And yet, the people who were watching structure instead of emotion knew that phase wasn't about failure. It was about pressure building. Markets don't reward impatience. They reward positioning before belief returns. Now look at where we are today. XRP has already proven it can reclaim multi-dollar territory. And yet the mood feels worse than it did at far lower prices. That tells you everything you need to know about retail psychology. Most people aren't guided by data. They're guided by frustration. And when frustration peaks, that's when people make the worst decisions of the entire cycle. At the same time, something far more important is happening outside of the chart. Regulators are no longer treating crypto like a fringe experiment. Institutions no longer speak in hypotheticals. Banks are no longer exploring. They're executing. This is what people miss when they stare at daily candles. Price moves last. Infrastructure moves first. Policy moves first. Capital structures move first. Price only reacts after the system has already shifted. The reason this matters for XRP specifically is because XRP is not positioned like a meme asset or a speculative tech stock. It sits directly at the intersection of regulation, banking, settlement, and institutional liquidity. That makes it slow during hype phases and explosive during normalization phases. That's the part most people misread. They expect it to behave like Bitcoin during mania. It doesn't. It behaves like infrastructure being quietly wired into a new financial system. And here's where the warning becomes real. We are approaching the point where bearish narratives about XRP collapse under their own weight. Not because of social media hype, not because of influencer optimism, but because the structure supporting those bearish views is being dismantled piece by piece through regulation, custody frameworks, treasury strategies, ETFs, and institutional partnerships that don't care about retail sentiment at all. Right now, the biggest risk is not XRP failing. The biggest risk is people abandoning positions right before the reason they entered finally begins to materialize.
That's not a dramatic statement. That's historical fact across every major asset transition. The majority always exits during the hardest middle phase. The minority that stays positioned is what people call lucky later. It was never luck. It was comprehension. So when you hear people saying XRP is stuck, understand that what they really mean is their patience is gone. When you hear people saying the market is boring, understand that boring is exactly what accumulation phases look like before they end. And when you hear people growing increasingly bearish right as institutional alignment accelerates, understand that you're witnessing the same psychological pattern that repeats in every cycle: disbelief before repricing. This phase is not about chasing pumps. It's about understanding where pressure is building before it releases. And if you don't know what just happened, what's quietly forming now, and why XRP's setup is fundamentally different from what most investors think, then you're navigating one of the most important transitions in this market completely blind. If you're wondering why XRP hasn't already exploded with all the positive headlines floating around, you're asking the right question. But most people reach the wrong conclusion. They assume the market is broken, manipulated beyond all logic, or that XRP has somehow failed to live up to expectations. What they don't understand is that this is exactly what early institutional positioning looks like when it's happening quietly instead of through a hype cycle. The loud phase always comes last. The silent phase is where the real accumulation happens. Look at the pattern you've already seen with other assets. Bitcoin didn't rip to new highs when institutions first showed interest. It stalled. It chopped sideways. It frustrated everyone. Only after the infrastructure was locked in, ETFs, custody, compliance, reporting, did price begin to reflect the shift. Ethereum followed a similar path once staking and yield became normalized for institutions. XRP is now entering that same phase, but with an even heavier regulatory and banking overlay, which naturally makes the transition slower and more controlled. Behind the scenes, the narrative has already changed. You're no longer hearing questions about whether XRP will survive regulation. You're hearing conversations about how XRP fits into treasury strategies, settlement frameworks, and custody pipelines. That's not retail language, that's balance sheet language. And balance sheet language moves slowly, methodically, and without concern for daily price fluctuations. One of the biggest signals people underestimate is what's happening on the acquisition side. Ripple isn't just expanding, it's absorbing critical pieces of financial infrastructure, custody, treasury management, and enterprise-grade settlement tech. That matters because whoever controls custody controls the flow of institutional capital. Retail can argue about price all day. Institutions care about who safeguards assets, who manages risk, and who complies with regulators across multiple jurisdictions. Ripple is positioning itself directly in that lane. At the same time, you're starting to see the early formation of structured XRP treasury strategies. Not speculation, not trading desks, treasuries. That means XRP is being evaluated the way firms evaluate foreign currency reserves, commodities, or strategic assets, not as a weekend gamble. When firms begin allocating hundreds of millions of dollars to an asset under a treasury framework, they aren't thinking in months. They're thinking in cycles measured in years. This is the part retail usually misses because it isn't spectacular. There's no parabolic candle. There's no viral clip. It's slow contracts, regulatory meetings, custody approvals, internal risk committees, and asset allocation models being rewritten. By the time those processes finish, price already reflects the decision. Retail only sees the end result and calls it unexpected. Now add in the macro layer that most XRP holders ignore when it doesn't suit their emotions. Interest rates do not stay high forever. Liquidity cycles always turn. When the Federal Reserve shifts from tightening to easing, capital doesn't drift back into risk assets gently. It flows with force. That's not opinion, that's historical behavior across every modern cycle. And when that rotation happens again, capital won't be choosing assets based on memes. It will be choosing based on regulation, custody, and institutional compatibility. XRP sits directly inside that selection filter. This is why the current price compression matters. So much compression is the market forcing uncertainty to its extreme. Bulls get tired, bears get confident, both sides become emotionally loaded. Institutions stay quiet. They let both groups exhaust themselves. And only after supply has been absorbed quietly and sentiment is weak does the repricing happen. Most people think price leads narrative. It doesn't. Structure leads price. Structure is moving right now through acquisitions, treasuries, regulatory alignment, and macro setup, even if the chart doesn't reflect it yet. And that's why the current phase confuses so many people. They feel like they're seeing two different realities at once. Strong signals everywhere, but muted price action. That disconnect is the giveaway. It's the sign that something is being built that hasn't gone public yet. The risk isn't that XRP fails during this phase. The real risk is that people misinterpret consolidation as stagnation and walk away right before the final layer locks in. Because once the structure is complete, the market doesn't ask for permission to reprice. It simply does what supply and demand force it to do. Now we get into the part almost nobody explains properly. The mechanics, not the hype, not the slogans, not the emotional predictions, the actual forces that push price when sentiment is irrelevant. Because XRP isn't going to move when people feel bullish, it's going to move when available supply collides with structured demand. And that collision doesn't announce itself ahead of time. It shows up suddenly after the groundwork is already finished. Start with the simplest reality. XRP does not have infinite liquidity on exchanges. It never did.